Welcome, folks. Today's an exciting topic and an important one. A few different ways to make money on an investment. You can make it as income, you can make it as dividends, or you can make it as capital gains. And essentially, the more money you make, the more you get taxed. So you get taxed at a federal level, and you also get taxed at a provincial level. So check this quick example out. Let's say you're making about $70,000. Looking at what you pay in federal tax, provincial tax. In this case, we've got CPP, Canada Pension Plan contributions, and EI, employment insurance premiums. You're looking at a take-home pay annually of $52,656. Needless to say, we pay a lot of tax. So let's quickly review the different types of money that you can earn. You've got income, which is essentially the money that you make working your everyday job. Also, you make income through investing in bonds. And if you've got a rental property and you're collecting rental income for your tenants, that's also income. For example, if you are investing in the stock market in something like TD Bank or RBC or many other different companies, some of them pay dividends, and this income that you get is called dividend income. Finally, you have capital gains. So if, for example, you bought an investment property 5 years ago, now you're selling it today. Again, also stuff like stocks. If you were to buy, for example, Amazon or Google, 2 years ago, and then you sold it today, for example, you'd probably have a pretty decent profit, and that gain, that profit is taxed as a capital gain. So how are these different types of investment income earned taxed? Because that's important. It's also about how much you get to keep, not only how much you're actually making. So things like income are fully taxed. So yes, your job income, bond income, that income is fully taxed at your income tax bracket. Then you've got dividends, and there's a special formula for that where they gross it up a certain amount, and then they have a tax credit. So it's a little bit more favorably taxed. And then you've got capital gains, which is the biggest incentive because you pay the lowest tax. So in fact, only 50% of your capital gains is taxable at your tax bracket. Okay, now let's get to the juicy stuff, the numbers. So let's say you made $100,000 in your job income in 2021, and you're an eager beaver. You said, you know what, that's not enough for me. I need to set myself up for the future. So you made an extra $50,000 on top of that. Let's take the first example. Let's say you made that extra $50K all in interest income, whether it be bonds, GIC, or you took an extra job as an Uber driver making some extra money on the side. So this earned income coupled with the interest income is all considered income. And from that, you're now looking at paying about 43% of tax on that, which is about $22,000 of taxes owing. So on the $50K that you earned in income, you get to keep $28,000 of that. That's just a hop, skip, and a jump away from half of it gone in taxes. Next, let's say you invested a bunch of dividend paying stocks and you made so much dividend income that worked out to $50,000. So again, there's a special formula that gets worked out. In this example, it's a little more favorably treated than regular earned income. So in this example, you've paid 27.1% tax, almost 1/3, but not quite. Total tax paid is about $13,500, and therefore from $50,000, you get to keep approximately $36,500 from the $50,000. Now, let's go to the final example, the third column, and let's say you made that $50,000 as a capital gain. You bought a rental property, you sold it, you made that 50K, or you bought some stocks, you sold them and made 50,000. Now, only half of that is taxed. So again, only 50% of that gain is a taxable gain. So in this example, you're paying 21.7% tax on that, which is almost $11,000. So you get to keep about $39,000, so almost $40,000 of the capital gain that you made. You get to keep about 80% of it, which is quite good. Again, the government does this to incentivize people to invest in companies, to invest in real estate, to help grow the economy. And that's why capital gains are more favorably taxed. Hope that helped. Love to share this free information. Your only cost is a free subscribe and a free like. So if you would do me that kind favor, I'd greatly appreciate it, so I could bring more of this content to more people, helping you to build your wealth. Bye for now.